Your money-making broadcast starts now. Good evening and welcome to the market close for Thursday, May 14th. A truly historic session on both sides of the border today. The Dow Jones Industrial Average closed above 50,000 points for the first time in its history, the S&P 500 added nearly 0.8%, and the Nasdaq gained 0.7%. But for Canadian investors, the standout story was the TSX, which outpaced its U.S. counterparts thanks to a blistering rally in energy stocks. West Texas Intermediate crude surged past $101 a barrel, the first triple-digit print since 2022, as geopolitical tensions in the Middle East escalated and supply fears gripped the market. The TSX Energy Index posted its best single-day gain in months, driving the broader Canadian benchmark higher. Let's unpack everything that moved markets today and what it means for your portfolio. The Dow's historic crossing of 50,000 deserves top billing, but it did not happen in a vacuum. The catalyst for today's broad-based rally came from Washington, where Treasury Secretary Scott Bessent delivered remarks signaling a more pragmatic, market-aware approach to tariff policy. Investors interpreted the comments as a de-escalation signal, and the response was immediate. The Dow cleared 50K just before midday and held the level into the close. Bessent's tone represents a meaningful shift from the administration's earlier protectionist posture, and markets are pricing in a lower risk premium as a result. Adding to the policy optimism, reports emerged that Kevin Warsh is now the leading candidate to succeed Jerome Powell as Federal Reserve Chair. Warsh, a former Fed governor with deep market credibility, is widely viewed as more attuned to financial conditions than the current leadership. His potential appointment drove bond yields slightly lower and gave equities an additional bid. The CBOE Volatility Index fell more than 3% on the day, confirming that the fear trade is rapidly unwinding. For Canadian investors, a softer U.S. trade stance is directly beneficial. Canada's economy is deeply integrated with American supply chains, particularly in autos, lumber, and agriculture. Any reduction in tariff rhetoric lifts a cloud that has been hanging over the TSX industrials and materials sectors all year. But the biggest story of the day, and the one most directly relevant to Canadian portfolios, is oil. West Texas Intermediate crude closed above $101 a barrel for the first time since mid-2022. The trigger is an escalating military confrontation between the United States and Iran that has raised real concerns about supply disruptions in the Strait of Hormuz, through which roughly 20% of the world's oil passes. The U.S. Navy has increased its presence in the Persian Gulf, and Iran has responded with heightened rhetoric. Global crude inventories are already at multi-year lows after disciplined OPEC+ production cuts, and any disruption to tanker traffic would create an immediate supply crisis. This is where Canada steps in. Our energy sector is one of the few globally with spare production capacity and established export infrastructure. Canadian heavy crude from the oil sands is flowing at near-record volumes through the expanded Trans Mountain Pipeline, and the differential between Western Canadian Select and WTI has narrowed dramatically, meaning Canadian producers are capturing more of the global price. Enbridge gained decisively today as pipeline utilization rates climbed. Suncor Energy posted strong gains as its integrated model, combining upstream production with refining and retail, provided both operational leverage and downside protection. Canadian Natural Resources also rallied sharply as investors priced in the likelihood of sustained triple-digit oil. The TSX Energy Index is now up more than 30% year-to-date, and the fundamental case continues to strengthen. At $101 oil, Canadian energy companies are generating free cash flow at levels not seen since the commodity supercycle of the early 2010s. Balance sheets are healthier this time around, leverage is lower, hedging programs are more conservative, and management teams are prioritizing shareholder returns over production growth. Dividend increases and share buyback announcements are widely expected in the coming quarters. For Canadian investors, this is not a speculative trade. It is a structural re-rating of a sector that was deeply undervalued when oil was below $70. On the corporate side, Cisco Systems delivered a beat-and-raise quarter that sent shares surging more than 13%. The networking giant reported stronger-than-expected revenue for its fiscal third quarter and raised its full-year guidance, citing insatiable demand for AI infrastructure and networking equipment. Cisco's performance is a strong signal that enterprise spending on AI build-out is accelerating and broadening beyond the hyperscale cloud providers. Networking is the backbone of AI data centers, and Cisco is seeing orders from clients who are upgrading their entire infrastructure to handle AI workloads. The stock's double-digit gain was one of the standout moves of the day on the S&P 500. In a related development, Cerebras Systems priced its initial public offering at $350 per share, well above the initial range, in what is being called the blockbuster IPO of the year. Cerebras, known for its wafer-scale chips designed specifically for AI training, was met with insatiable demand from institutional investors. The successful pricing validates the thesis that the market is hungry for AI hardware exposure beyond a single dominant player. Cerberus went public at a valuation north of $20 billion, and the stock is expected to begin trading tomorrow with significant momentum. The IPO pipeline in AI and semiconductor-adjacent companies is now wide open, and a successful debut from Cerberus could unlock a wave of additional offerings in the second half of the year. Not every tech stock participated in today's rally. Qualcomm fell more than 6% after reporting that a key handset customer was reducing orders. The move appears to be a rotation within the semiconductor space rather than a sector-wide signal. Money is flowing out of mobile-focused chipmakers and into AI infrastructure plays like Cisco and Broadcom, which gained more than 5%. The rotation is also visible in memory chips, with Micron Technology falling over 3%. The narrative is clear: AI-related capital expenditure is crowding out spending in traditional end markets, and investors are repositioning accordingly. For Canadian investors, this theme matters because it creates opportunity for Canadian-listed companies that serve the AI ecosystem, from data center operators to power infrastructure providers. Consumer debt reached an all-time high in the first quarter, with total household debt surpassing previous records. This is a story of two economies. Higher-income households are benefiting from rising asset prices and robust wage growth, while lower-income consumers are increasingly reliant on credit cards and personal loans to cover basic expenses. Delinquency rates are ticking higher in auto loans and credit cards, though mortgage performance remains solid thanks to the long duration of fixed-rate debt. For the TSX, this bifurcation favors banks with strong commercial and wealth management franchises over those with heavy exposure to unsecured consumer lending. Royal Bank of Canada and TD Bank are better positioned than peers with larger subprime footprints. The debt story will be a key driver of bank earnings in the second half of the year. The Schwab crypto trading platform launched today, offering spot crypto trading to its millions of retail clients. The move is a major legitimization event for digital assets, bringing cryptocurrency trading into the mainstream brokerage ecosystem. Alongside the Schwab launch, several asset managers filed for XRP exchange-traded funds, expanding the crypto ETF universe beyond Bitcoin and Ethereum. While these developments are US-focused, they have implications for Canadian investors through the Galaxy Digital Holdings stock and through broader sentiment toward technology and fintech names listed on the TSX. Now let's move to our stock picks for tonight. We are featuring for companies with significant ties to the Canadian market, each analyzed through the lens of a different investing legend. Our first pick comes from Peter Lynch, the legendary Fidelity manager who popularized the buy-what-you-know approach to investing. Lynch would be drawn to Enbridge, the Canadian energy infrastructure giant. Enbridge operates an irreplaceable network of crude oil and natural gas pipelines that serve as the circulatory system of North American energy production. These assets generate toll booth-like cash flows that are largely volume-driven rather than price-dependent, providing stability even when commodity prices fluctuate. With oil above $100 and North American production rising to meet global demand, pipeline throughput is set to increase meaningfully. Enbridge currently offers a dividend yield approaching 7%, and the company has raised its payout for 30 consecutive years. In Lynch's framework, Enbridge is a textbook stalwart, a slow but steady grower with a dominant market position, reliable cash flows, and a shareholder-friendly management team. At current valuations, it offers a compelling total return proposition for Canadian income investors. Our second pick comes from the value investing pioneer, Benjamin Graham. Graham would find significant opportunity in Suncor Energy. Suncor is Canada's largest integrated energy company, with operations spanning oil sands production, refining, and retail gasoline distribution through its Petro-Canada network. Graham's investment framework is built on the concept of margin of safety, buying assets for less than their intrinsic value. By that measure, Suncor is deeply compelling. The company's oil sands assets represent decades of low-decline production that is currently being valued at a fraction of its replacement cost. Its downstream operations provide a natural hedge. When crude prices fall, refining margins typically expand, smoothing Suncor's earnings profile. At $101 oil, Suncor's free cash flow yield is among the highest in the North American energy complex. Graham would note that the market is pricing in significant pessimism about long-term oil demand, ignoring the reality that the energy transition will take decades, and that oil will remain a critical part of the global energy mix for the foreseeable future. Suncor offers both a margin of safety and a catalyst in the form of higher oil prices. Our third pick comes from Cathie Wood, the founder and CEO of ARK Invest, known for her focus on disruptive innovation. Wood would make a compelling case for Shopify, the Canadian e-commerce powerhouse. Shopify is the operating system for independent merchants worldwide, and its platform is being transformed by artificial intelligence. The company's new AI-powered features, including automated product descriptions, personalized marketing, and intelligent inventory management, are increasing merchant productivity and driving adoption. Shopify's total revenue grew over 20% in its most recent quarter, and gross merchandise volume continues to expand as more retail shifts online. Wood argue that Shopify is at the intersection of three powerful trends: the structural shift to e-commerce, the democratization of entrepreneurship, and the monetization of AI through practical business tools. At current levels, she would argue that the market is underestimating Shopify's ability to expand its take rate through Shop Pay, Shopify Capital, and Shopify Fulfillment. The stock has been volatile, but for growth-oriented investors with a long-time horizon, Shopify represents a high-conviction bet on the future of commerce. Our fourth and final pick comes from Phil Fisher, the growth investing pioneer who wrote Common Stocks and Uncommon Profits. Fisher believed in buying exceptional companies with durable competitive advantages and holding them for the long term. TD Bank fits that framework perfectly. TD is one of the most efficient banks in North America, with a best-in-class retail franchise in Canada and a rapidly growing presence in the U.S. Eastern Seaboard. The bank consistently generates a return on equity above 15%, and its expense ratio is among the lowest in the industry. Fisher would appreciate TD's culture of disciplined risk management. It was one of the few major banks to emerge from the 2008 financial crisis without needing a government bailout. The bank's U.S. retail business now accounts for roughly a third of total earnings, providing geographic diversification and exposure to a faster-growing market. TD's dividend has grown at a compound annual rate of approximately 10% over the past decade, and its payout ratio leaves ample room for continued increases. For patient investors who follow Fisher's approach of buying great companies at reasonable prices, TD Bank is a core portfolio holding that can compound capital through any market environment. Looking ahead, the combination of record highs in the Dow, surging energy prices that disproportionately benefit Canadian producers, and a more constructive policy backdrop from Washington creates a favorable environment for equities. The TSX is uniquely well-positioned among global benchmarks, with its heavy weighting in energy, financials, and materials, all sectors that stand to benefit from the current macro configuration. Oil above $100, a dovish policy pivot, and strong corporate earnings form a powerful trifecta. However, investors should remain disciplined. Geopolitical risks remain elevated, consumer debt is at an all-time high, and equity valuations are not cheap by historical standards. The key is to own high-quality names with strong balance sheets, predictable cash flows, and durable competitive advantages, the kind of businesses that thrive in any environment and compound wealth over time. Discipline and selectivity will separate the winners from the losers in this market. That is the market close for May 14th. I'm Chloe. See you at 7 a.m. Eastern for shorts. Subscribe for market insights. Check our shorts for a 60-second highlight. That's all for today. We all become wealthy together.